What's up, fellas? So I'm on go through the rest of the chapter tonight. We won't have class tomorrow, and then next week we will finish chapter 2 on Tuesday. On Thursday we'll have a little review and a test prep assignment, and then a week from Tuesday will be our first test. So if you guys remember on Tuesday, we got to factory overhead and how we calculate factory overhead. And what we said was they usually choose a driver. Um, and they use that driver to allocate factory overhead in total to the different jobs. Okay, and so we worked this problem right here where we had direct materials and we had indirect materials, indirect labor, indirect accumulated depreciation, and things like that. And so we worked that problem. Then we talked about how they allocate it. In the example we had, they use $5 or they use direct labor as the allocation tool. And that was where we finished on Tuesday. All right, so I'm going to pick up right here. The journal entry to apply factory overhead to work in process. Remember, work in process is part of inventory, so it's an asset. Um, so you would debit work in process, and the journal entry to apply factory overhead increases, debits work in process, and decreases factory overhead. So the way they do that is they would debit work in process, credit factory overhead for those amounts right there that we looked at for those two jobs. So to summarize, the factory overhead account is increased for the actual overhead costs that were incurred, and then it is decreased when you get ready to apply that overhead to work in process. Okay, so the actual and applied overhead usually differ because the actual overhead is going to be different than the estimated overhead cost. So we talked about that. So they use direct labor as an allocation tool, but they don't know exactly what factory overhead is going to be. Now, obviously, at the end of at the end of the month, or the end of the quarter, they can go back and calculate it. But throughout the course of the month, as they're looking at their job costs, they need to be able to know in a roundabout way what factory overhead might be. So they use that tool to allocate it. Most times, it's going to be different than what actually turns up to be overhead. So let's look at these two things right here. So if the applied overhead is less than actual, then the factory overhead account would have a debit balance. So that debit balance is called under applied factory overhead, which makes sense because if what we estimated for is more than what actually happened, then it was under applied. If the applied overhead, which is our estimate, if it is more than what we actually incurred as overhead, then we would have over applied factory overhead, and that would give us a credit balance. Okay, and that makes sense as well. Hopefully, it does for you guys. So now they give us a problem to look at. So it says Grayson Computers estimates that total factory overhead cost will be $100,000 for the year. Direct labor is estimated at $25,000 for the year. Company has two completed jobs at the end of January, jobs 101 and 102. Direct labor hours and units produced for these jobs are as follows. So using the information right here, they want us to determine the predetermined factory overhead rate using direct labor hours as the activity base. Then secondly, the amount of factory overhead applied to those jobs in January. Part B, prepare the journal entry to apply factory overhead to both jobs. Then C, using the information provided, determine the balance on the job cost sheets and the cost per unit for jobs number 101 and 102. So what would we do first? So in part A, it says we need to figure out the predetermined overhead rate using direct labor hours as the activity base. Okay, so we're going to start with estimated total factory overhead cost. And if you look up here, they give us that number. The total factory overhead cost will be $100,000 for the year. So we take that $100,000 and we're going to divide that by direct labor hours because that's what we're going to use as our activity base. So $100,000 divided by 25,000 hours is going to give us a cost of $4 per direct labor hour. And that's going to be our applied overhead rate. All right, so then number 2, they want us to apply that to the amount of factory overhead in jobs 101 and 102. And we base that on the 700 direct labor hours for job 101 and the 600 direct labor hours for job 102. So we multiply those out, 2,800 for job 101, 2,400 for job 102, for a total of 5,200. It says the factory overhead cost applied to each job is recorded on the job cost sheet for each job. Okay, so then in part B, it says to prepare the journal entry to apply factory overhead to both jobs in January. So remember, we are applying this to work in process because we are allocating those costs to the work in process goods. So we're going to debit work in process inventory and we're going to credit factory overhead for the combined total of $5,200. All right, then part C, using the information provided, we are going to determine the balance on the job cost sheets for those two jobs at the end of the month and the cost per unit for jobs. All right, so when we look at job number 1, we had total direct materials of 2,800. We had direct labor of 11,200. And then we had factory overhead of 2,800. And those numbers, the 2,400, ouch, and the 11,200, I believe those came from earlier examples when we were looking at it. And they're just summing all those up here. So you took direct materials of 2,400, direct labor of 11,200, factory overhead of 2,800, and total cost for job number 101 of $16,400. Okay, and then you divide that by 500 units produced, which we see right here, and that gives us a per unit cost of $32.80 per unit. For job 102, that cost per unit is $13.80. So those two jobs, you can't necessarily compare the unit costs because they could be doing two completely different things. So we don't have enough information to make that correlation, but that's how we would calculate the cost per unit for the job. And you may be asked to do parts of that on your test, so that's something that I would look over as we go forward. Okay. Let's see here. All right. So let's go forward and let's look at work in process. So during the period, work in process is increased for the following. If I can figure out how to do that. So work in process is increased for direct materials cost, it is increased for direct labor cost, and then it is increased as we apply factory overhead to work in process. Okay, so then it gives us an illustration and it says during December, work in process was debited for the following: direct materials cost of $13,000, direct labor cost of $11,000, applied factory overhead of $4,250. And it's just showing us how we add those to the job cost sheets. Then it says we move goods from direct materials to work in process. And then once a job is finished, it would be moved out of work in process and into finished goods. So for us to do that, it says during December, job 71 was completed. Upon completion, the product cost, direct materials, direct labor, factory overhead are totaled. That total is divided by the number of units produced to determine the cost per unit. Thus, the 20 Jazz Series guitars produced at job 71 cost $512.50 per guitar. So after that job is completed, that entire balance moves into finished goods and out of work in process. Okay, it says job number 72 was started in December, but was not completed. So it's still part of the work in process inventory. So we would not move it over until that job is complete. All right, so now let's look at finished goods. So the finished goods account is a controlling account for obviously our finished goods stock. Okay, each account in the finished goods ledger contains data for goods manufactured, goods sold, and units on hand. So it says the exhibit indicates that there were 40 jazz guitars, which you can see that number right there, on hand on December 1st, 2008. During the month, 20 additional jazz guitars were completed and transferred to finished goods. In addition, the beginning inventory of jazz guitars were sold during the month. Okay? And that just gives us, here's those 20 being added. So now we are walking through finished goods inventory. Okay? Now obviously once something leaves finished goods, it's considered a sold item. And we're going to see that step next. So once you have finished goods and you get rid of them, they obviously are considered sales, and we have to consider cost of goods sold. So during December, Legend Guitars sold 40 Jazz Series guitars for $850 each, generating sales of $34,000. All right, Exhibit 8 indicates that the cost of the guitars were $500 a guitar for a total of $20,000. So in a merchandising business and in a manufacturing business, and this is something that we talked about in Principles of Accounting, anytime you make a sale, you have to record two journal entries. You have to first record the sale, which debits either accounts receivable or cash and credits sales for the amount of the sale. Then we have to account for the cost that were associated with that sale, as well as getting rid of the inventory that we just sold so that we no longer have it on our books. So you see part A, they're recording the sale. They debited accounts receivable for $34,000. That's the cost, or that's the actual revenue they received. And then that's H, not A. Then in part I, they are recording the cost of goods sold. That's the expense that went into making all those goods that they sold. So you debit cost of goods sold, which is an expense, and you credit finished goods inventory, which says we no longer have these guitars in our possession. Okay? So in a job order cost accounting system, the preparation of a statement of cost of goods manufactured is not necessary. And that's because job order costing uses perpetual inventory system. So the cost of goods sold can be directly determined by looking at the finished goods ledger. So it saves you a couple of steps. Okay? Then we have to look at period cost. So you remember we have product cost and period cost. And period costs are the selling and administrative expenses that go along with our products. Okay? So period costs are used in generating revenue during the current period, but they're not involved in the manufacturing process. So like we said in class, we could possibly sell all of our goods without salesmen and without office staff, but a lot of times it helps the process move along faster. So as discussed in Chapter 1, period costs are recorded as expenses of the current period as either selling or administrative expenses. And it says selling expenses are incurred in marketing the product and delivering sold products to customers, and administrative expenses are incurred in managing the company, but are not related to the manufacturing or the selling functions. All right, so those are all expenses. Sales, salaries expense, office salaries expense, and expenses are debited to increase. And then how would we record, or how would we pay those salaries? With salaries payable, which is a liability. So that's why we have salaries payable credited in this example right here. Okay, then just kind of looking at the cost flows for this company. You know, we said when we started Chapter 2 that we were not going to look at some of the individual ledgers. I was more worried about the high, looking at it from 30,000 feet and looking at the transactions that we would see moving direct materials into work in process, recording direct labor, moving work in process inventory into finished goods. I'm not looking at the individual ledgers because I feel like that would muddy the waters and it's just more detailed than I feel like we need to get in our conversations. So this is showing you some of those subsidiary ledgers. I'm not going to spend any time on those. You shouldn't either. So let's see here. All right, I did want to speak a little bit about the income statement. So when we look at an income statement of a service company, they are not going to have cost of goods sold. Why is that? It's because they don't make anything. They provide a service. They don't have any cost associated with making a product. So therefore, they would just have sales. Excuse me. They would just have sales and then expenses and then gross profit. Where for a manufacturing company or a merchandising company, they're going to also have sales, but they're going to have costs that are associated with the goods they sell. And so to calculate gross profit, we take sales minus cost of goods sold. That gives us gross profit. Then we take out our period cost. So for gross profit, that's just looking at the product. It only takes into account product cost. Then we look at selling and administrative expenses, which are period cost. And after we subtract out our period cost, then we get our actual operating income for our business as a whole. Okay? That is actually where I want to stop for today because, and I know it's a really short lecture, if you remember on Tuesday, we went further than I was supposed to go on Tuesday so that you guys wouldn't have as much to listen to today. On Tuesday, we will finish up 2.3. We will review the chapters, and then Thursday we'll have our test prep assignment, and then a week from Tuesday we'll take our test. All right, thanks you guys for being flexible and allowing me to be at the doctor, and I will see you guys on Tuesday. Have a great weekend.